What if I told you that for centuries the money in your pocket wasn't just paper? It was a promise. A direct, legally binding promise for a specific amount of pure physical gold. This wasn't some fantasy novel. This was the gold standard, the system that governed global finance for the better part of a century. It was the backbone of an era. But if it was so solid, why did we build it? And more importantly, why did we tear it all down? Stick around as we dig into the vaults of history to uncover the truth. In its simplest form, the gold standard was a monetary system where a country's currency had a value directly linked to gold. A government couldn't just fire up the printing presses whenever it felt like it. If they wanted to print more money, they needed the actual gold in their vaults to back it up. For ordinary people, it meant you could, in theory, walk into a bank and exchange your paper bills for an equivalent weight in gold. Imagine that. Trading your dollars for a little piece of solid, glittering metal. The great promise of this system, the reason it lasted so long, was stability. Because the money supply was tied to a finite physical asset, it was incredibly difficult for governments to simply print money to pay their debts or fund endless projects. This kept a monster at bay: inflation, the silent thief that eats away at your savings. For decades, the price of a loaf of bread or a new suit barely changed. This gave people tremendous confidence in the long-term value of their money. You could save for the future knowing your hard-earned cash would hold its worth. But this incredible stability came at a steep price: inflexibility. Think of it like a train on a track. It's stable, it's predictable, but it can't swerve to avoid an obstacle. If an economy fell into a recession, a government's hands were tied. It couldn't inject money into the system to stimulate growth, create jobs, or rescue failing banks, because it simply didn't have the gold reserves to back up that new cash. The golden promise had become a rigid prison. And in the 20th century, the walls of that prison were about to be tested like never before. The world was changing, and the old rules were about to break. The Great Depression was the first major blow. As the global economy went into a terrifying freefall, countries on the gold standard were trapped. To prevent a bank run where everyone exchanged their currency for gold, they had to keep interest rates high. But high interest rates choked off borrowing and spending, making the economic downturn catastrophically worse. One by one, nations faced a terrible choice: defend their gold reserves, or save their people from unemployment and starvation. It wasn't a hard choice. They chose their people. Britain was one of the first to jump ship, leaving the standard in 1931. Then, in 1933, the United States followed suit. President Franklin D. Roosevelt, in a decisive move, temporarily ended the dollar's convertibility to gold for its own citizens. The golden age was dimming. The system that had promised ultimate security was failing at the moment of ultimate crisis. A new approach was needed. After the devastation of World War II, the world's leaders gathered at a resort in Bretton Woods, New Hampshire, to build a new financial order from the ashes. They didn't go back to the old gold standard, but they didn't abandon it entirely either. They created a hybrid system. Under this Bretton Woods agreement, the U.S. dollar would become the world's reserve currency, and the dollar in turn would be convertible to gold at a fixed rate of $35 an ounce. Other countries would then peg their own currencies to the U.S. dollar. It was like a gold standard, but with the U.S. and its dollar acting as the world's trusted banker. And for a while, it worked. The post-war era saw an unprecedented economic boom. Global trade flourished, and economies rebuilt themselves. It was an age of prosperity, all seemingly anchored by the golden promise of the American dollar. But beneath the surface, cracks were beginning to form. America's role as the world's banker came with huge responsibilities, but also temptations. The problem was that America started spending a lot. The costly Vietnam War and expansive domestic social programs, known as the Great Society, required the government to print far more dollars than it could ever back up with the gold sitting in Fort Knox. The U.S. was writing checks its gold reserves couldn't cash. Other countries, especially in Europe, weren't blind. They could do the math. They saw the U.S. flooding the world with dollars and realized that the promise of $35 for an ounce of gold was becoming fragile. By the early 1970s, those countries started getting nervous. They began showing up at America's doorstep, figuratively speaking, demanding gold in exchange for their mountains of U.S. dollars. And America had to pay up. This started a massive drain of U.S. gold reserves. President Richard Nixon was cornered. He could either raise interest rates dramatically, plunging the U.S. into a nasty recession to defend the dollar, or he could break the promise altogether. On the evening of August 15, 1971, he made his choice. Nixon appeared on national television and announced a series of economic measures. The most important one was a bombshell. He was unilaterally and immediately severing the final link between the U.S. dollar and gold. The gold window was closed. This move, which became known as the Nixon Shock, sent ripples across the entire planet. Just like that, with a single speech, the gold standard was dead. For over 50 years now, the world has lived in the age of fiat currency. That's the money we use today. It's called fiat because its value comes from a government decree, or fiat, that it is legal tender. It's backed by nothing physical, only by faith and trust in the government that issues it. This system has given central banks incredible flexibility. They can now print money to fight recessions, bail out banks, and manage the economy in ways that were impossible under the gold standard. But this power has also opened the door to persistent inflation and levels of government debt that would have been unthinkable in the past. So this brings us to the big question. Could we ever go back? It's a debate that still rages today. Proponents, sometimes called gold bugs, argue that it's the only way to restore fiscal discipline. A return to gold, they say, would force governments to stop their reckless spending, tame inflation for good, and create a more stable, predictable financial system. For them, it's a return to what they call sound money. It's an appealing idea, right? Forcing politicians to live within their means. However, the vast majority of mainstream economists believe a return to the gold standard is not just impractical, but downright dangerous. For one, the world's economy has grown so enormous that there simply isn't enough mined gold on the planet to support it at a stable price. Trying to do so could trigger a catastrophic deflationary spiral, where prices and wages fall, debt becomes impossible to repay, and the economy grinds to a halt, a nightmare scenario eerily similar to the Great Depression. The cure, they argue, would be far, far worse than the disease. The story of the gold standard is really a story of a fundamental trade-off, the classic battle between stability and flexibility. It was a system built for a simpler time, an era that prized certainty and predictability above all else. We abandoned it for a dynamic, complex, and sometimes chaotic system that allows for massive growth and lets us manage crises, but at the cost of constant risk and the slow, steady erosion of our money's value through inflation. There's no easy answer. What do you think? Was leaving gold the biggest financial mistake in history, or a necessary step into the modern world? Let me know your thoughts down in the comments. Thanks so much for watching. If you found this dive into economic history interesting, please give this video a thumbs up and consider subscribing for more content just like this.